stepping aside just from the question of accounting standards and looking at the value of reporting and accounting within entities particularly, but also to other parties. If, for example, you are a smallish proprietary company, you're not required to lodge financial statements, what should you be doing about your own accounting and reporting within your own sphere? On the one hand, you could take a very simple view of this, that the corporation's law requires you to have adequate books and records, and a basic set of accounts every now and again will be part of complying with that requirement. And you might take the mentality that this is largely a tick-the-box compliance exercise that, if anything, is taking time away from the business. That's one mentality. I think the other mentality is to look at what we are trying to do in general purpose financial reporting and think about what can be learned from that and how useful it might be within a business. For example, financial instruments are thought to be a very complex part of general purpose financial reporting, and they can be. It is possible to have some very structured, difficult, sculptured circumstances in which determining the correct accounting is quite difficult. But the basics of that area are things that I think any business would need to think about. Every business will have financial instruments of some sort. They'll have receivables or payables, which are plain vanilla financial assets and liabilities, and the accounting for those is no different than you would be familiar with from the viewpoint of your mortgage on your own house. So there's nothing particularly complicated there. But as soon as you start to enter into other types of instruments, you really do need to pay attention. There is nothing to stop a small business actually holding almost inadvertently a derivative that could spell the end of the business. We've certainly seen examples of small entities with fairly exotic derivatives, sometimes blissfully ignorant of how exotic they are. But just as a large business can be blown out of the water with a derivative, so too can a small one. So when you're managing a business, you need to understand how a derivative works, how you might actually become involved with one accidentally, and what you should be thinking about over time while you hold it. When I say you can have these accidentally, one of the most common sources of derivatives are to be found in the small print of contracts, either for goods and services sold, or for financings received, or in the context of maybe acquiring another business. Quite often those sorts of clauses that constitute derivatives are actually sewn in by lawyers just to cover off on some unlikely prospects, and therefore they're not paid much attention. Well, at the other end of life in the large companies, those same sorts of clauses were the clauses behind why banks have got enormous problems with credit risk derivatives that previously were thought to be the source of a lot of money and no risk. They turned out to be anything but riskless. So there is something to be learned even at the most complex end of life. The broad message that I would give to you is, no matter how arcane accounting standards might seem to be to you, they are being driven by a desire to reveal the economics of a business. So if you're not broadly following the thoughts that are in those requirements when you're thinking about your own informational needs, implicitly you're ignoring some aspect of the economics of your business. Is that good management, would be the question. It doesn't mean you have to go to all the ends of proper disclosure for outside parties, external users, but nevertheless the decisions you're making should be based on information that is relevant to you. And there will not be too many parts of the core of individual accounting standards that are not relevant to that thinking.